Hi, folks. I wanted to speak about Bitcoin cryptocurrencies one more time in the wake of Bitcoin reaching some record high valuations these last few weeks. And I have done an extensive coverage of why I am opposed to Bitcoin in the previous videos. Please watch the past videos that I've done to get a thorough picture and understanding in terms of why I oppose these instruments. I have the last video that I did, which is episode 126. I looked at the Bitcoin stock to flow ratio, defenses of why it is valued and why it's valued, and the fact that it is fixed supply, and I debunked those reasons. And in the video before that, 125, I did a thorough analysis of how other asset classes and commodities who have high stock to flow ratios normally behave, and how that is similar to Bitcoin, but also how that is dissimilar to Bitcoin, which is what I did in episode 126. In this video, what I wanted to focus on was to take us back to the stock market crash of 2008, which was known as the subprime based or real estate based stock market crash. And the claim that I'm making here in this video is that Bitcoins have something similar with the underlying financial instruments that led to the stock market price. And those underlying financial instruments are collateralized debt obligations, which are in short called CDOs. And in more specifically, they are called mortgage-based security. And obviously, I need to explain to you in what way are Bitcoins similar to mortgage-backed securities and CDOs, and in what way are they dissimilar, or are they not the same? I have to say that because when you're making comparison between two things that are not alike and that are not based on similar assumptions, people come and then they make bad faith arguments of disagreement, and then they argue things that you did not argue, and then they accuse you of things that you did not say at all. So I'll first start by assuming that everyone understands what Bitcoin is, and then now I'm going to start now by defining what are mortgage-based backed securities and collateral debt obligations. I'll start with the CDOs, which is a collateralized debt obligation is a complex financial product that pulls together various debt obligations such as mortgages, corporate bonds, or other loans, and repackages them into discrete tranches of varying risk and return, and these tranches are then sold to investors, with lower tranches offering higher potential returns but also carrying greater risk of default. So the key characteristics of these CDOs will be this. CDOs involved aggregating a variety of debt instruments into a single pool. And this pool of debt is then divided into different tranches with varying levels of risk, and then they then allow financial institutions to transfer this credit risk associated with the underlying debt to investors. And then, with that said, CDOs then are a type of asset backed security, meaning that their value is derived from the underlying assets, which is the pool of debt. And so, in this particular instance, what they would do is you go to a bank, you originate a mortgage to buy a house or an apartment or a condo in Houston or Austin or Dallas or Galveston, El Paso. You go through the process, you cross the T's and the dots, the bond or the mortgage is approved. You purchase a house, the bank pays the seller the amount, and you are obligated to the bank for 20, 25, or 30 years to pay back this mortgage. Normally, what would happen in the past would be that the banks will hold these loans in their balance sheet. But then over the years, some geniuses came up with the idea of pulling together these loans, grading their level of risk, slice them and dice them, and then sell them to investors in the stock market as mortgage-based securities, which is a unique instrument. And then, which means that any Tom, Dick, and Harry who is investing in the market, stock market, can go to the stock market, New York Stock Exchange, London Stock Exchange, and buy, so to speak, a share of these securities. So then, in essence, what therefore that means is that you who borrowed money to buy a house or an apartment actually don't owe the bank money anymore. You owe Tom who bought shares on the stock market exchange of these mortgage-based securities. So the transaction now is between you and the person who owns those securities, which then actually helps banks to show their balance sheets as to have lower risk than they would be if they were owning all of these loans. And as time went by, as in the United States, they were pushing the purchasing of buying houses as this American dream, banks started becoming more and more creative and more risk-taking in terms of who they were approving these loans to. Because they were making so much money by selling these securities on the stock market, they started selling more and more houses and approving more and more bonds, even to people who did not meet the risk profiles of being able to pay back the bank the money that they were owing the bank. But banks were making so much money selling these in the open market, and they were making so much money through bonuses and all of that they just continued doing, and everyone was making so much money that no one was willing to pull the handbrake and to take a pause from this very risky activity. But also the problem is that over and above this, when people were buying these mortgage-based securities, they will also buy insurance to secure their future positions of these securities with large companies like AIG. But what would happen though is that it was very much possible that more than one person would take insurance for the same instrument, meaning that the insurance providers were potentially being exposed to limitless amounts of liability if the underlying asset failed. This is to say, if the person, you who bought the house, was no longer able to pay back the loan. But they were also making so much money selling the insurance for these securities that no one was willing to warn anyone about what they were doing. Ever more so, there is a situation of the rating agencies, which is S&P and Moody's, who were giving these mortgage-backed securities AAA ratings, meaning that they were telling the investors that these securities are extremely, extremely safe. And the problem with these rating agencies is that they get paid by the very same people who they are supposed to rate. And if Moody's will not give a bank a AAA rating for a security, they can just go down the road. Actually, they have offices opposite each other, and they will get a positive rating from S&P or Fitch. And so this entire system was so rotten that no one knew exactly what was in these securities. And nobody knew what they were worth. That is where the similarity is with Bitcoin. The similarity is not that these are instruments that are based on same asset classes, or that they are even a similar asset class. One is a currency, one is a financial instrument. The one financial instrument is entirely based on real estate, and another is entirely based on whatever Bitcoin is based on, which nobody knows. So, and I'm not saying in any way that these are the same. No, they are not the same. The similarity, in as far as they are similar, is that the people who are selling these two things don't know how to value them. And the fact that they don't know how to value them is not stopping them from selling them to you. That's really when the rubber hits the road. So if I take this thing even further with regards to mortgage-based securities, is that once the borrowers of money to buy these properties around the United States started failing and defaulting on their loan repayments, the issue was not just the cascade of number of defaults. The issue was that the securities that were sold in the open market were not properly valued. So it's not just that there was loss that was going to happen inevitably, as in when it happens that there's a cascade of defaults. There was an issue of saying that they've been selling something to the tune of trillions of dollars, which they did not know how to value, and they did not know what it was worth. And the fact that they did not know how to value it did not change the fact that they were making billions of dollars year on year selling these instruments. So then what ended up happening was that in 2009, there was a SEC inquiry and investigation in trying to understand the nature and the extent of what happened in the 2008 stock market crash. And what they actually found in this investigation is that Lehman Brothers, Merrill Lynch, Bear Stearns, and Morgan Stanley, and the other banks admitted under oath that they were selling something to investors they did not know how to properly value. Are you with me, folks? These banks, which were built out by the taxpayer to the tune of close to $1 trillion, admitted under oath that they were selling an instrument to the public which they did not know how to value and which they don't know its value. Folks, for the most part, these bankers, they were making so much money from these instruments that they continue to sell them even though they themselves did not understand them. Because sometimes you can get confused by all of this finance, like smart sounding language and lingo, as if people who have these finance degrees or economics degrees, especially those who specialized in financial instruments and stuff, asset valuation, that they know what they are talking about. For the most part, yes, they do. But when it comes to this particular instrument, they did not know what was in them and they did not know how to value them. They were just basically trash. And things did not even get any better when then you deal with the valuation companies in terms of how then did you give these instruments AAA valuation if you don't know what is in them and if you don't know how to value them. And Fitch and Moody's and all of them, all they said is that our valuations are simply opinions. That's what they said. These are opinions. It's in the dotted line. When we give a valuation to a client who's seeking a valuation, they know that this is an opinion. And because of that, they were able to escape responsibility. Because they were saying, Muti, these are all just opinions. It has to be repeated that the issue with these mortgage-backed securities, CDOs, was not so much that it was not so much that the mortgage bonds were junk status, which they were junk status, the bonds that were in these packages. The issue here was that the people who were selling these bonds or mortgages who were junk status to the investor did not know how to value them. And they did not know what their value, as they admitted. Because if you don't know how to value something, and if you do not know what its value, then how are you going to properly insure it? Because insurance work in the same way value can be within reasonable parameters be approximated or be known accurately. Then you can take out insurance because risk can be quantified. You can't quantify risk when something can't be properly valued. Because assume that we had this cascade of bad debts happening as they started happening in 2007. If these CDOs were properly valued and properly priced, we wouldn't have had a global stock market crash. Because the insurance, even the insurance premiums of these CDOs would have appropriately estimated the risk and then would have brought some cushion to the damage on the balance sheet of these banks. But because no one was interested in knowing what the value was of these instruments, the global economy was sent into a tailspin. How is this similar to Bitcoin? It's similar in the fact of saying that the people who are selling Bitcoin to you do not know what the value of this thing is. And they don't care. They are making too much money. And normally the pathology of a global disaster happens when there is a widespread adoption of something that is poorly understood, to the point where governments put money into it, and they put pensions, government worker pensions into it, teachers, nurses, firefighters, doctors. They put large sums of money into something that is poorly understood, because what tends to happen is that there becomes this group thing that if this government is adopting it, and that government is adopting it, this must mean that this thing is secure and safe. And then once there's widespread acceptance of something, widespread acceptance and widespread adoption of something that is poorly understood, then you have a global market crash that wipes out almost half the world's economy, to the point of having economies like Greece and Belgium and Spain being actually declared bankrupt. That is what happens. And looking in terms of how much Bitcoin is universally being applied and being adopted now, I'm afraid what will happen? What will happen? Because this SEC investigation into CDOs took years. People were subpoenaed. And they admitted under oath that they did not know what was going on. I'm warning you, folks. I'm warning you. Yeah, with that said, I would like to hear your thoughts below. There are some comments that I've received that I still haven't responded to. I will respond. I just haven't had time. I will respond either individually or I'll probably make a video. But please, these videos, watch them in this sequence, and that will be much more helpful for you if you watch them in the order in which I made them. Thank you very much. I'll see you on the next one.